Today it's a big day. Eco-survey will be tabled on the floor of the parliament. Eco-survey is an important document, and this time the eco-survey is important because this is the first eco-survey from the new chief economic advisor, Raghuram Rajan. So what are the expectations from this year's eco-survey? And in terms of macro, how are Indian macro shaping up versus global macro? Let's discuss that with the country's two renowned economists, Jahangir Aziz, chief economist India for JP Morgan, and along with him Rajiv Malik, senior economist with CLSA, who joins us from Hong Kong. Gentlemen, good to have both of you on ET Now. Thank you for joining us. Rajiv, let me kickstart this one with you. What are you expecting from today's eco-survey in terms of emphasis, and what to your mind could be the likely tone?
I think it's probably going to be, reflective of the fact that, India has been hit by a pretty bad global economy, and that, it has tried to do what is best under these very difficult circumstances. It's probably also going to talk about the slowdown in investment, and but we look forward to a better growth performance in FY14. And I think it's going to also talk about the fact that inflation, even though it hasn't really come down as much as they had hoped to, is on the way down. I think it's going to raise worries about the current account deficit. But beyond that, I think it's going to give a pretty modest view about how the recovery process is going back, and that, the 8-9% growth rate that India used to enjoy some time back will take a few more years for it to reach.
Right, spending cuts, Jahangir, will help India achieve 5.3% fiscal deficit. But do you think spending cut tool can be relied upon for a long time without hurting growth?
Look, it's almost impossible for spending cuts to be the only instrument with which the government consolidates the budget deficit. I mean, there isn't really that much of overall spending that can be cut. You can, reallocate the spending, make it more efficient, move away from subsidies to capital expenditure. All of that is fine. But over time, India will actually need to spend more rather than less. So it can't be an instrument over the medium term. It can be a short-term instrument, as has been shown in this fiscal year. But ultimately, India will have to rely on finding new sources of revenue. And that is clearly something that one is looking towards the FY14 budget, in particular a roadmap to where GST is going and how quickly it can be implemented.
Rajiv, this question is coming your way. The Indian finance minister has already set a fiscal deficit target of FY14 at about 4.8%. Do you think that he needs to come up with something more than a credible plan which will convince market that he will be able to achieve his numbers?
Well, that's what the budget is going to be all about, as to what exactly is the arithmetic behind it. I don't think anybody, or I certainly don't doubt his intentions, but don't forget, A, this government has an exceptionally poor track record of delivering on its fiscal promises. 2, just because he delivers in FY13, which is the year ending now, doesn't mean he's going to deliver it again, especially since this is probably going to be the last budget before the next general election. So I think the details are going to matter a lot more. Hopefully it won't be a paper tiger, in the sense that on paper it shows and says what everyone wants to hear. But as the year progresses, the government loses that kind of fiscal discipline that has actually made a meaningful difference over the last 6-8 months.
Right, Jahangir, do you see a risk of slippages during FY14, especially in the second half, closer to state elections and run-up to national elections?
Well, I do think slippages the second half of the year will come through, even if the broad direction of the fiscal deficit trajectory remains the same. So, for example, while the indicative number is going to be 4.8% of GDP, I would suspect it's going to be closer to 5% or so. Not a big slippage, but it just essentially underscores that in a politically sensitive year, it's just very, very difficult to cut spending, especially on subsidy front. Also, don't forget that there's a bit of smokescreen going on. While the government is cut fuel-related subsidy, its outgo on food subsidy, especially because of the food security bill, is actually going to go up. So, overall subsidy reductions are very important, but aren't necessarily going to be a cakewalk.
Rajiv, one part will be the borrowing part. The budget will also impact the bond yields. What are you penciling in your budget maths on that front?
Well, our own calculations show it's going to be at the gross level a number at 5.97, which is not really very different from what the general word is. This is slightly higher in rupee terms over the prior year, but lower as a percent of GDP. I think that level of borrowing, which would be a record high, again underscores how the fiscal adjustment can at best be gradual. One doesn't need to turn into a fiscal fanatic, but even then, a lot of the adjustments that are happening now need to be complemented by other structural initiatives as well.
Rajiv, do you expect mention of timeline on goods and services tax in the budget, and could this spur growth for India in future?
Well, I think there will clearly be more news in terms of GST, possibly some kind of a roadmap. I'd be surprised if the finance minister can actually commit to a timeline. Don't forget, the timelines in India tend to be exceptionally flexible. And it would yet again be another loss of credibility as such. So he might give some broad brushstrokes in terms of what can be expected over the next year or so.
Jahangir, what is your take on GST?
I'm really hoping that he puts out a timeline. I think that is going to be critical. I'm really hoping that he actually has in the budget a credible, well-defined timeline so that the GST can be implemented from next year by whichever government comes into power after the May elections in the budget. I think that will clearly be a critical element of FY14 budget.
Right, and inflation as well has been sticky, an issue for India. RBI says there is only limited room to cut. What is your view on this?
That's a separate issue, whether he really has room to cut rates or not. I mean, if you look at CPI, inflation is running at 11%. But RBI, by cutting rates in January by 25 basis points and stating that it expects inflation to roll down, and based on the government's efforts till then, it somehow boxed itself in. If the government actually delivers a 5.3 or a 5.2 outturn for last year and a 4.8, 4.7 FY14 deficit target, and with inflation actually now running below the March end target of RBI of 6.8%, I think that the RBI will find it very difficult to say, no, I'm not going to cut rates in March.
Jahangir, India's saving rate has been declining. Do you expect any measures or schemes to attract retail investors to equity markets, or measures to convert unproductive savings in gold and real estate to more productive instruments?
I mean, why is gold unproductive? I mean, gold has been the best investment that the households of India have done over the last 3 years. I mean, if you look at the equity performance and look at performance of gold, I mean, the only people who really showed any signs of, they were very astute in actually delivering, in actually investing in gold. And the same with real estate. I mean, real estate isn't an unproductive asset. So I really don't think this entire furor over getting people out of gold and into quote-unquote productive asset. I mean, at the end of the day, households have to be given the freedom to choose whatever asset they think is the right thing for them to invest in. Gold is an excellent hedge against inflation. India does not have any inflation-linked instruments, and as long as the government of India or the RBI or the SEBI it does not allow households to invest in a manner that can hedge against inflation, households will invest in gold. And that's the right thing for households to do. I think it would be, it is not the right thing for us to go and say that because we think gold is unproductive, therefore households shouldn't invest in it. They should be given the instruments to invest in inflation hedge instruments, which we haven't given them. So, they are going to invest in gold, and I think that's the right thing for households to do.
Rajiv, do you still see danger of ratings downgrade to India?
Much less so at this point. To be fair, over the last 6 months, the government has undertaken some measures. And I think with the forthcoming budget, the issue is going to be less at just the headline numbers, for example, what the fiscal deficit is as a percent of GDP, and more in terms of the qualitative adjustment. And I think here it is important to bear in mind, once again, the government is not necessarily approaching it the way it should be in a disciplined manner, because much of the cuts are going to come on the plan side, which, although in India's inefficient implementation is not all productive, but a bulk of it tends to be at the more productive asset creation category. So that's not the kind of cuts we need to see, because they have a longer term impact as far as the broader growth capability is concerned.
Jahangir, could there be any risk to easy foreign flows that India has been experiencing or seeing so far?
I think that, we need to see ourselves relative to what is happening to other emerging market countries. And if you look at what is happening to current account deficits or current account surpluses of other emerging market countries, and look around the globe, from Brazil to Turkey to Indonesia to Malaysia to China, everyone's current account surpluses have come down. And those with current account deficit have seen a significant increase in current account deficit. Growth across emerging markets have come down. And my guess is that, on a relative basis, India's performance isn't as bad as we think it is sitting in India. And therefore, the flows that we are talking about, which is backed by a massive increase in liquidity, by the Fed, by ECB, and now lately by Bank of Japan, necessarily has to find a place. And my guess, therefore, is that unless the government does something really silly and really stupid like last year's budget, where it threatened to retroactively tax or impose GAR, if the government doesn't do something as silly like that, my guess is that those flows will continue into India almost at the same pace as it has over the last 2 months or over the last 6-7 months, actually.